All right, ladies and gentlemen, we are live here. Okay, we are very fortunate today. From Prosperity Mortgage, we have real estate extraordinaire, mortgage expert, Mr. John Ingram. John, hit star
Hello.
6 on your phone. There you are. Welcome, John.
I'm here. Hi.
All right, my man. What's going on, man? Get us caught up. What's going on out there in the mortgage world?
Excuse me. Yeah, it's certainly interesting times we're living in, where we went into the year with very optimistic sort of thought process in regards to interest rates going down. We saw the Federal Reserve cut interest rates a total of 1% last year on their Fed funds rate, and that typically bodes really well for mortgages as it's sort of a foundational kind of basis for all other borrowing throughout the sort of the economic world, and
right.
We didn't really get that. So it's we're living in interesting times. You got multiple sort of headwinds and forces at play here. So the Fed's not working in a vacuum. So ultimately what we saw was, from a year ago to today, we're basically flat, even though the Federal Reserve has cut their rate a full 1% in that time frame. And so we're waiting for sort of other things to ultimately settle out. I think the market is in a place where there's a ton of indecision and a lack of vision to see where things are going, based upon the idea of what legislation gets passed, what changes are done, what effect do tariffs have on the economy? Does it slow the economy down? Do we see job losses and that sort of thing, which would be a world where the Federal Reserve would cut into to help put a floor underneath the economy? Or does it have the opposite effect, where we see businesses in the United States actually ramp up and start manufacturing more things here? So there's a lot of to be determined. The best experts that I listen to right now are thinking that the second half of the year is where we get sort of the results of at least some of these moves, and we get a little better clarity of what we can expect out of this new administration and their effect on interest rates and the economy. So it's kind of interesting times.
It is interesting times, and I just read right before we started, Trump started the tariffs, and Mexico is he's already cut a deal with Mexico like 15 minutes ago, to put military, like when he was president before, military along the border.
10,000 troops onto the border.
Right.
Yeah, that's what they're saying.
Right. So the stock market looked like it was plummeting, but now it's come back halfway and it's still headed back up. He's got an appointment with Trudeau at 3. I'm sure they're going to work something out because nobody wants. So, and then, so I think it's, it's just a different style, I think, but I agree with you. I mean, the Fed, we went from 0 to 5.75, I think it capped out at it, or 5.5. They've come down one now, so now we're at 4.75, I think, or 4.5. It would be nice for them to do because we did 4.75s in a row. It'd be nice for them to say, you know what, boom, here's one of those. They went up really fast, and now they're going down really slow. It'd be nice to see this to do something, because I agree with you though. The economy is definitely healthy. It's like they're artificially suppressing it so it doesn't ignite even further, which, I don't know. I understand the concern about inflation.
The inflation conversation, right? Where
right.
We've seen interest rate or inflation in its total range come from nearly 9% down to, call it 2.8% right now. And, there's an interesting conversation out there in the world. And I know a letter has been sent to the president and his new Treasury Secretary on this, but talking about how the calculation of the inflation rate is a bit antiquated. And it's really...
it really is.
The big problem with it is how it calculates housing. Housing, depending on the different inflation report that you're looking at, can be as much as 46% of the total inflation rate. And they're saying in the numbers that housing is still screaming higher ultimately. If you were to calculate it using sort of today's data, like last month's data on what housing and rents are doing, you would actually see we have the inflation rate that the Fed wants right now. We'd be at 2.1 instead of 2.8 if you calculated it instead of using this rolling 12-month average and just did it on today's latest readings. And I think that's kind of interesting, right? Now, certainly those of us in the industry would say that, housing pricing, while it's going up, is not screaming higher. Rents are coming down in many areas. So those two combined things really have an effect. And inside the inflation numbers and the way they calculate it, one of the interesting things to me is they take into account, or a large part of the housing number itself, they go around to homeowners and say, I know you're not renting your house right now, but if you did rent it out, how much would you rent it out for? And they take that sort of perception and convert that into the inflation rate calculation for housing, which is weird to think about. There's no fact behind it. It's just simply, what does the owner think it would rent out for, not what they're actually renting it out for.
Right.
And, all of this
Zillow
becomes the spaghetti.
Zillow, Trulia, Realtor.com, they all give you the estimates. They give you the number, and then they give you the rental number too. So they have those out there too. So yeah, we have tons of good data out there that the Fed could be looking at, and they just don't. That's where I go to like the antiquated nature of it. Whereas they look at a few hundred products to see are prices moving higher or lower. We have sources out there that look at millions of products and determine whether prices are moving higher or lower. And they're using the old stuff, and maybe that's the wisest decision. I hesitate to actually say it's a bad decision, but it does have consequences. Right. Yeah. They almost want the economy to look like it's going to falter before they lower rates too much. So they don't run it like a business. They run it like a government. And that's the unfortunate part. And that's always been my argument, is if you ran it like a business, you would be looking ahead. And like I don't know if you remember the last time you and I spoke, I've been saying that for a couple of years now. They have to redefine how they do inflation, because the way they do it is stupid. It's way your house appreciates and everything goes up in value, and that hurts it doesn't even make sense if you think about it.
Mm-hmm. The other side of the equation they're looking at is employment, right? And I love that it sort of made the headlines last year, but the BLS, the Bureau of Labor and Statistics, does a employment report, and they ended up overstating the number of jobs by 800,000 jobs over the last roughly 6 months of the year. Like the way they calculate their number is in question. The interesting thing for me on that is, inside their calculations, they use a historical sort of baseline of the last 5 years for the number of businesses that open up and create jobs and the number of businesses that die, that close down and lay employees off. So they're basically using their best estimate, best guess for that, and they do that by using a 5-year average. Well, what happened in the last 5 years for us? We had the COVID weirdness, where a lot of businesses were created inside that time that maybe really didn't exist, to be able to take advantage of some of the government incentives and employee retention and stuff. There was a lot of weirdness that happened in that last 5 years, and maybe that's part of the reason why we're seeing their estimates be so widely wrong. Because eventually, as you go forward in time, you get the real data. The government does eventually get the data, and that's when they start adjusting these numbers and correcting them down. And therefore, that's how you get to 100 or 800,000 overstated being removed from the number. The problem we have in the industry is the markets react to the headlines. When the number first comes out, that's when the market is deciding whether interest rates are going to get better that day or go worse that day. We don't get back the gains that we would, the lower interest rates that we would have had if those 800,000 extra jobs were not put inside the numbers. We don't get that back. It's only on the headlines and the initial reaction to stuff that the market is moving and making its judgments. So this is just our world right now. But there does seem to be some easing in the employment side of things. There haven't been really large job losses or anything like that are worrying about, but the rate of people's pay and people changing jobs for better pay, that's certainly slowing down and is moderating and taking some of the employment inflation out of our market. And so those two big factors, the actual inflation rate and price stability, basically, and then employment, are the two mandates of the Federal Reserve. And so we're looking at both of those when they're deciding whether they're going to cut rates further or whether they hold steady or even raise. With all the latest data, the idea of the Fed raising has been reduced, or that the chance of that has been reduced in more recent days. If you went back, say, a month ago, there was some concern, well, could the Fed actually raise rates? And that has eased back, which is nice. We're in a world where maybe we get to the second half of the year and the Fed is able to cut a little bit more. Probably we're looking at May, June as the next chance for the Federal Reserve to actually move based upon how the inflation data is calculated. Once again, if you play the math out and you see, today's numbers, when they come into the calculation and start to really push that inflation rate down, is May, June is when we start to see that kind of fall, and that gives the Fed some cover to cut further and whatnot.
Right. Okay. And so that base rate is part of the equation. The other one is the T-bill, mortgage-backed security. So tell us a little about that situation, because even when the Fed dropped, it looked like the T-bill was heading up, and looks like it's kind of leveled off. So how's that going?
Yeah, you're correct about that. Those two things are very, very tightly linked. The 10-year Treasury is the government instrument that mortgage-backed securities follow most closely. And the idea there is the average 30-year mortgage is expected to live 13 years. The closest and mortgage-backed securities in most cases have government backing on them. So 13 years versus 10 years, that's the closest sort of equivalent. And so we see that mortgage rates typically move in the same direction as that 10-year Treasury. We've seen it rise up to 4.83, I think is the most recent peak, and has now drifted back. Where is it sitting today? I think I still have this up. No, I don't. But it has fallen down slowly this year, or this last, say, 2 weeks or so. And while I was worried that it was heading all the way to 5%, luckily it has reversed direction and has been heading down. And we've seen mortgage rates improve a bit, say 1/4 to 3/8% has come out of the 30-year fixed mortgages in the marketplace. And that's been a nice relief. You're still, in your conventional loan world, you're still likely in the 7s to start with, somewhere, say 7.25, 7.1. The Gubby loans, you're getting a better deal on. You can start potentially in the high 6s or mid 6s and get it down into low 6s by paying a little points. That's still a popular sort of option to get past the psychological hurdles that people have about paying 7%. That does seem to be a real line in the sand. We see applications pick up and start to speed up when the rates fall back below 7. We've seen that happen, and as they rise back above, they slow down again. So psychologically, that's a big thing. I think agents out there in the world would increase the number of deals that they were doing if they were using the temporary buy downs as a tool, getting the seller to pay some of those costs to drive that interest rate down, and helping the consumer to actually understand that in a way where, in cooperation with what we're trying to educate them on. That's still real in the world. But I think ultimately we wobble in this kind of range, say anything from 6.75 to 7.25. We're wobbling there for a little bit of a time, and until the second half of the year, where the Fed can give us a little more encouraging news. The market can read that and say, okay, well, inflation is going down, and we can see these interest rates fall a little further. Investors are willing to take them at today's price instead of worrying about things getting worse in the future.
Right. Yeah, and I think, this since the election, like 2 weeks into December, it's like the market definitely hit another gear, and January busy-wise and so forth. It's so it's picking up, because I think people are just, okay, we're getting used to these rates, and I want to do something, and I think they're confident they're going to come down eventually, so they can always refinance. And then you guys have that great deal. You can give them 3 years from the day, right? 3 years from the day they close to refinance with no lender fee, which is incredible. And I just don't think people, which I think those people are smart that are doing something now. And I know I'm supposed to have this attitude, but I've been doing this for 40 years now, and I know what's coming. When the rates hit, my guess is like the high fives again, all hell's going to break loose, because there are so many more people that can buy
for sure.
than houses available, right? That it would, I'm not going to say it's going to create like a tail end of COVID type thing, or, when we opened up for COVID, we went through like probably 15 to 18 of the best months ever in history. I don't know if it'll be that, but it's going to be something like that once the rates hit a certain amount. Would you agree on that?
There's going to be millions of people coming into the market and off the sidelines. Yeah. And there's really two different sides of this. One is, if you can crack into the fives, say the high fives, 5.75, 5.5, there is the psychological sort of aspect to this, which is sellers seem to be the human interpretation people and studies that I've read have said, if you can get within 3% of their current interest rate, they'll transact. So those people that are locked into homes at 3 or 3.5 or 2.75, if you can get them within 3% of that number, they'll justify making the move to the next house, which will let us sell more homes. And then when you're talking about the number of buyers, if you think about just their ability to qualify, what that difference does to their monthly payment and their sense and feeling of whether it's a smart move or not, that's millions of people. And so when we see that happens, whether that's, towards the end of this year, next year, the following year, when it happens, there's going to be just a boom in housing again, as we see from time to time in the marketplace. And so, any client who's looking to make that decision today, I continue to say, you need to be buying now so that you can get ahead of the appreciation that's coming in the future in these homes. It's real estate is buy and wait. It is not wait and then buy. That's the bad strategy. Right. You cannot time the market that way. No. So yeah, I think you're 100% correct as far as what's coming and what we need to be prepared for. And we are probably, people ask me, well, when do you think it'll change? And I go, well, all I know is that we're not building. I mean, they're talking about ways to build faster and to do more housing and so forth, but it's not implemented yet. So at the current production rate of new homes in the country versus the possible consumption of the amount of people we have that could do something is crazy. That's why you see, like, we're in Vegas, so you see, and you see this, and you see the rental properties going up massively because they know there's going to be a certain amount of people that just are going to have to rent forever if they don't buy soon, because we're going to get to that point, like Los Angeles, San Diego, the Bay Area, New York, whatever, and where, only a certain amount of people are going to be able to buy. And it's the people that put a lot of money down, right? If they're lucky enough, and there are stats on like how first-time home buyers are getting into this market now. Well, it's the savings of the boomers. It's their parents giving them that down payment, giving them the heads up, even the grandparents, let's say. But that's the reality. That's just the way it's going to sort of work. You're either going to do it the traditional way, which is I buy my starter home, my compromise, my condo, whatever that may be, and work my way up by flipping properties every couple of years, let's say every 3-5 years. And that's how you ramp yourself up to the dream home, let's say. Or if you're lucky enough, you have family that hooks you up with a nice big down payment, and you can get closer to that dream home right out of the gate. But that's what we're seeing. And you're correct in regards to talking about just the numbers of things. If we have roughly somewhere between 1.7 and 1.9 million households being formed, and we're building, and I'm sorry, that's on a yearly basis, and we're building about 1.3, 1.4 million new homes a year, well, you can see how those don't equal each other, right? That is a foundational element to why we see housing prices rise, rents being able to rise over time. And so getting into the game, being an owner of a home instead of a renter, is your only way to keep pace with this stuff. You need your house going up in value so that you can keep up with the other houses going up in value. Yeah.
Well, yeah. And if I was, like my two oldest live in New England still, and, I tell them if I could do it all over again with today's conditions, or if I had to do it all over again with today's conditions, the first thing I would do is I would buy a multifamily, and FHA will allow you to go up to a fourplex. So you buy a fourplex, you live in one, you rent the other, right? Then you can now you have your investment property as you move into your next property. Now, we don't have as many of those properties around the Phoenix and, California and Nevada, but there are some, and I would, even a 2-family or a 3-family is a great way, because that's a great product. FHA allows you up to a 4-family as your primary residence.
Exactly. It's huge. I also look at it as what a great way to be able to retire and be at the finish of your life. Because now, if you look at the profile for me, would be great if early in life, in my 20s, I was that person to be sort of really capable of managing a fourplex property and being able to pay for the repairs when they need to happen and that kind of thing. But there's only, I think, a small segment of people that might be really ready for that, as opposed to my senior clients who are looking for an affordable place to live, who have experience, been around the block, know how to maybe talk to people and deal with problems, as well as might have some savings behind them. That's like an ideal clientele to buy a fourplex townhome. That would be amazing for them and fit that niche quite well. And this works well on the VA loans and the FHA loans, where you just get really small outlays of down payment and cash in order to acquire those properties. And in the Vegas area, you can go to nearly $1 million fourplex property.
I know, isn't that crazy?
FHA loan. It's unbelievable.
Can't you even if you need to factor in fixing the property up a little bit too?
And do like a rehab in a way?
Yeah, I don't know. Is there a way to do a fourplex where, like I say, it needs some work, so you finance in that, and you do you live in one unit while you fix up another one, then you rent that one out, then you is there a way to do that as well?
You could do like 203K, which is like the rehab loans, where it's giving you the dollars. If it was just a matter of I want to acquire the property and fix it up at my own speed, and I'll pay for those repairs, then yes, that works as well. But if you're looking for the loan to give you the dollars to correct the property, then you need one of the rehab versions, whether it be like in the conventional world, there's a loan called a home style renovation loan, which actually is significantly easier to deal with than the 203K under FHA rules. But yeah, those exist and are solutions for those homes that need a bit of TLC for sure.
Mm-hmm. Yep. So, I mean, there's just so many different ways that you can do this. And I just think that, and I think more and more people are seeing it, right? That's why I think we're seeing an increase, that interest rates are only part of the equation. When there's never a scenario that renting is better, okay? Because, you don't have tax advantages, you don't have principal reduction, and you don't have appreciation when you're renting. You're just spending the money, right? So, and then
100%
like
interest.
100% interest, and you can refinance. Nobody keeps a 30-year mortgage. Like you said, the average is 13 years, which is up a lot. compared to 10 years
the
ago.
red herring. For sure. It is false math to look at yourself on the terms of what will this cost me over 30 years? Well, it is very abnormal for a consumer to have a mortgage for 30 years. That's super rare. And even own the house for 30 years. That's a rare thing. People tend to, they refinance, they sell and upgrade, they sell and put the money in their pocket. There's different moves there to do it. And one miscellaneous idea that I want to throw in here. How great is the idea of you have a child, you buy an investment property. That investment property, you keep it for the 18 years, the child going up. Then when it reaches ready to go to college, you sell the investment property, and voila, no student loans. The house has paid for that child's college, right? Through the appreciation, through tenants paying down the balance of it. I think that's a brilliant sort of plan for people to do. So real estate is just one of those things that works historically, basically forever, until we stop needing houses, I guess, and we just live in bubbles in space. I don't know. Can I share two other things that people might not be aware of? And it's sort of,
we have exactly 2.5 minutes left. We have 2.5 minutes left. So give us, absolutely.
3 weeks ago now, the CFPB passed a rule which is going to call for all medical collections to be removed from your credit report. It will no longer be allowed for a creditor to consider a medical collection sort of against you in their credit decisions. That is going to be sort of implementing its way through the systems over the next 90 days, but that's a super powerful thing. There are roughly 15 million Americans with medical collections totaling in the neighborhood of $49 billion. And that is just going to go away as a problem. So big positive change there. And that's coming down through the regulators and telling the credit bureaus and the credit industry what they have to do. Second thing is, very quietly at the end of the last administration, they changed their agreements with Fannie Mae and Freddie Mac, which is setting the pathway for them to be able to be made public companies again and off the government books. That one's going to be super important that we do correctly. So keep your ears open for stories about that and news about that, because it's just one of those things. If they do it right, it'll be good things for us. If they do it wrong, boy, they can hurt our industry. So we need to keep paying attention and commenting on that as stuff goes forward.
All right. Well, that's good stuff. I didn't know that. So perfect. All right. Well, John, thank you very much. John Ingram, ladies and gentlemen. Prosperity Mortgage, give them a shout. They're incredibly awesome, and they're always super competitive on rates and every other program.
J.D. Power's #1 for customer service in 2024.
That's right.
I'm very proud of that. I had to throw that in.
That's right. You had to. I'm sorry. I almost forgot. Wow. Yeah, absolutely. J.D. Powers. So you're the best, my man. Thanks for taking your time out. Appreciate it.
Thanks, everybody. Good morning.
All right. Have a good one, John. Thank you.
You too.